Good afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And joining me today, as always, is David Burrows, our Chief Investment Strategist and President of Barometer Capital. On this webcast today, we will provide you with a brief macro overview. And of course, at the tail end of our conversation, we'd be pleased to address your questions. So don't be shy. Email me at phastings@barometercapital.ca or hit me up via the chat on the Zoom link. And with that, I turn the conversation over to David Burrows. Hi, Dave. Happy February 1st.
Thanks, Pam. It's nice to soak up some sunshine, at least through the window over the snow. But it's a nice warm day here in Toronto, and markets have been a little bit more friendly. So we got lots to talk about. We'll jump right in. So Great. Thanks everybody for joining us today. Lots of things to talk about. Certainly, it was an interesting week. Very difficult Monday. Last Monday, we did the webcast on Tuesday. We had a view that we may have put in a near-term bottom in the market. But we still had to face Fed Day, which came later on in the week, and certainly there was a little bit of bumpiness. Market was up when the Fed statement came out, but in the press conference, frankly, Jerome Powell just could not help but hide his hawkish nature, having been reappointed and reconfirmed with the filters off, used fully the bully pulpit to not only make comment on what they were planning to do, but after saying he didn't want to postulated on how many what the Fed's path might be, and the fact that the inflation data might be a little bit worse than they expected, and market sold off in the afternoon. That probably concluded the retest of the market's bottom. But let's just talk through things from a high level. Of course, as always, we start out with the fact that we think that we are in a structural bull market that started in 2013 when we exceeded the 2000 highs. Structural bull markets tend to be much more consistent than you expect. There are big pullbacks along the way. Certainly 1987 crash was one of them. The 1990-91 recession was another. If we think about the current bull market that we're in, we had our first pullback in 2015-16. We had another one in 2018, and of course the COVID bear market that took place until March of 2020. However, structural bull markets go on a long time. They tend to shake people out often because people think they've been going on too long. And the hardest thing to do in a bull market is to stay invested. Frankly, once you get into a bear market, things get difficult and stay difficult. And the hardest thing is to be a good seller. And these are important lessons that investors learn. But you go from a point where everyone loves an asset class to, by the end of a bear market, everyone hates it. And once things start to rally, that's the reason why they are continually looking for their exit point. So we think that we're in a bull market and that the US started it, and it is going on around the world, and the equity asset class ultimately has a tailwind. For interest rates, we think that we have concluded a generational disinflationary period from 1981 through 2020, COVID low, and that we have made a turn and we are into a generational upturn in rates and reflation, much like what started in the early 1950s or what started after the Depression. So if we look at where we are, the 10-year bond yield has been very resilient, despite the fact that December and January were two very tough months for the stock market. 10-year yields really did not pull back. And in fact, here we are very close to recent highs, about 1.8% on a 10-year bond. I think they got as high about 1.87. And typically, if you thought that a market that was correcting was telling you that there was a problem with the economy, or that there would be a slowdown, or that the Fed would choke off growth, you would have expected to see yields come down and bonds to rally. And that simply was not the case. 2-year yields continue to be very resilient. We've moved from 20 basis on a 2-year bond in September to 116 basis points today. In fact, after the Fed's comments, yields certainly rallied sharply, because the view was that they were going to be a little bit more hawkish. So the bear market in bonds continues. It started back in March of 2020. It continues today. This is an ETF made up of various issuers. and various maturities and various credit qualities. But you can see that very clearly bond prices are moving lower. I think as people are opening their annual statements for 2021, they're probably going to get a little bit of surprise. Some of those more cautious fixed income investors will find that their portfolios are worth less. And that is for the first time in many, many years. There is a mountain of money in the bond market. Some of it has to be there. A lot of it doesn't. And our premise is that we will see money slowly rotate from fixed income and things that act like fixed income into things that do well in reflation as opposed to things that do well in disinflation. So that brings up commodities. Of course, commodities are a reflationary asset. And we know that they went through a significant bear market from 2008 through 2020. The 10-year annualized returns went from being broadly positive, multiple teens, sort of 14, 15% a year, to by the end of the bear market in 2020, almost minus 9% a year for the previous 10 years. That will shake out a few investors and make it a much smaller part of the market. And we've seen that reverse and back through the zero line. Last time that happened in the early 1950s, you had about 20 years of double-digit returns in front of you. The same thing when you had it happen in the 1930s. Same thing about 15 years later, you had sort of 12, 13% returns annualized. So that's significant. That means that you may well get paid well for the risk that you take to be in the group. We saw the bear market that went on from 2008 through 2020, where the index was down 77%. This is the Rogers Equally Weighted Commodity Index, has been working its way higher, broke the downtrend early in 2021, consolidated a little bit through the fall, and now resuming its upward move. So is it continuing? Yes, we are virtually at new highs. Despite the little correction in the market, through the corrective period from the end of December, relative to the S&P 500, made very nice gains. That's been our premise, that this could be an asset class that will outperform, and it's one that we've spent a lot of time looking at and talking about. For the S&P 500 itself, this was the chart we put up last week. There was about a 12.4% sell-off from top to bottom, made a low early last week. And if we look at it today, we're trading back above the 200-day moving average and have regained about a third of what was given up through that corrective period. And of course, the S&P is dominated by different groups. Very large part of the S&P is technology. Technology, has had a difficult period through the course of the year. It finally got to large cap tech stocks in the end of December. But when we look at the S&P overall from a longer term perspective, we know that we have only dipped over the last several years below the 50-week moving average 2 times. One was during the bear market, the quick bear market in the end of 2018, where we quite quickly reclaimed it and carried on. And then the COVID bear market in 2020, where we dipped and reclaimed it fairly quickly. And we've been above the 50-week moving average ever since, including last week when we got to the lows. Things that we care about. Volatility spiked to 38 on Monday of last week when the market made its first low. On Fed Day, when we saw the retest of those lows, what was very interesting is that volatility failed to recoup the previous highs that were made earlier in the week. So one of the things that we really want to watch is when the market retests a low, does volatility spike and move beyond the previous high, which means likely market participants think that the weakness is going to carry on? Or does volatility fail to make a new high, in fact, make a much lower high, which means the vigor of the decline is running out of steam? So we put a bunch of metrics up last week that showed that some of the things that were happening in the market were getting to extremes: the bearishness, the number of people buying puts, the volatility, and these things seem to be dissipating. Of course, volatility has taken a sharp turn lower over the past week as people are stepping away from what they thought was perhaps a precipice. The weakness started in the market early in the year last year, specifically in the Nasdaq, where the percent of stocks trading above the 200-day moving average started to fall, meaning the weakest securities were selling off first, while the generals were carrying on. And eventually, of course, it got to the stronger stocks. Here's the Nasdaq 100. Nasdaq 100 fell 18.2% from top to bottom from the end of December through last Monday. And yes, it has bounced a little, but clearly there was a lot of damage done inside the Nasdaq. The number of securities down by 50% or more from 52-week highs as of last week got to 1,700. The last time we were there was 2008, and the time before that was in 2000. So this has been a quite significant sell-off in the Nasdaq, something we had to work hard to avoid from getting too badly damaged in. We did have more significant technology weight. As you'll recall, early in the fall, we were about 27%, which was around market weight. And it came down steadily till by the time we got to December, it was about 12%. And of course, as of 2 weeks ago, we were 6%. We continue to have a very low weight there. So the Nasdaq has had a bounce. It's not the same vigor as what we've seen in the S&P. We're sitting here now still below the 200-day moving average. We'll see whether the Nasdaq can get back above, but we're still a long way off the highs. And certainly in things like the ARC Innovation ETF, which we talked about last week, which was 59% off the highs, it's bounced a little over the last few days, but clearly not enough to make us have an interest in making a change in our allocation. I always like to say, what is it that was weakest going into a correction? That's something to be careful of. When it rallies, it may just be short covering. Is it something that follows through or regains its relative strength versus the market? And what I would say is, despite bouncing, quite strongly early last week, really has not had a ton of follow through. So today it was down about 0.75% when I was putting this together. I think it probably closed a little bit better than that, but frankly, relative to other parts of the market, not so inspiring. When we look at the group work that we do, where we're tracking breadth or the percentage of stocks within each sector that are performing well, you can see that semiconductors, healthcare, drugs, and biotech only have between 0 and 14% of all of the constituents in that sector in clearly defined upward price trends, meaning breadth has been very, very weak. Now, we did see semiconductors, computer group, internet, and software show some improvement this week, but continues to be a show me story. On the other hand, groups that we've been focused in, things like Wall Street, forest products, oil and gas, banking, and finance, these groups have had strong relative performance. And we're going to retest today how they did over the last little while. Have they maintained their strength versus the market? And are these groups that we want to continue to be invested in? We do know that cash positions were raised over the last few months quite substantially, and that money, if the market has found a footing, should have to be redeployed. We also think, as we said earlier, money can come from the bond market, which has been a losing proposition, and work its way into equities in asset class reallocation. We also think that some of that money can find its way into basic materials. We do know, though, that by the time we got to the end of last week, fewer than the bull-bear spread, the spread between the bulls and the bears, had become the most bearish it's been going back to 2013, and before that, 2008. So certainly this correction acted as a reset for sentiment. It acted as a reset for positioning, and it acted for a reset in some of the key sectors. The question is, where do we go from here? We put up last week that one of the things that was most positive about what we had seen in this correction was, despite the fact that the markets pulled back quite sharply over about 14 days, the degree to which stocks were behaving similar to one another did not spike. In other words, correlations stock to stock within the S&P 500 remain low, meaning they are not all moving together like a flock of geese, like they did in the panic of 2020's COVID, or if you were to go back 2008 or the year 2003. Correlations remained very muted. That means the market's functioning. And in fact, what it also means is that while there may be some very weak groups, the money is moving from weak groups to stronger groups. And to put it another way, if we're looking at the groups, moving from disinflationary focused sectors to sectors that benefit in a reflationary environment, which probably sounds like a broken record because this is what we've been talking about for the last 12 months. The sector spreads, the differential between the best sector last month and the worst, were the highest that they've been going back over the last 30 years. Energy was up sharply, consumer discretionary was down sharply, a lot of dispersion, money moving, elephants moving their feet. We talked last week about what happens often after sharp, quick sell-offs. They tend to happen in bull markets, and we tend to be positive 3, 6, and 12 months later. It's looking like that may be the case. So let's talk about the data from the week. Lots to look at. Just quickly, we talked last week about the fact that we've been coming into the earnings period. We were expecting a very big divergence between certain sectors. 20% of the S&P 500 is basic materials, industrials, energy, and consumer. We expect those groups to have earnings up about 97% with 23% revenue growth and big margin expansion. The rest of the S&P, we expect it to have relatively muted earnings growth, about 10% revenue growth and zero margins. Here's what we know. For the S&P as a whole, sales growth so far in the reporting period, 16% average sales growth and earnings growth of about 30%. But big divergences. Energy revenue up 81%, and you can't measure the earnings growth because it was coming from a negative number a year ago, very positive this year. We look at materials, revenue growth of 35%, earnings growth of 95%. Consumer discretionary, 30%, 28% revenue growth, earnings growth of 80.1%. So those things are coming through. There is divergence. The one thing I would say is that the sales surprise continued to be positive on average, and earnings surprise continues to come in above expectation, but not as much as we've seen in recent quarters. And I think that the market kind of expected that. The behavior coming out of earnings has been sort of muted. We do know, though, that the fundamental backdrop, the earnings estimates for 2022 continue to rise. They're not being curtailed in the face of Fed rate hikes. They're not being curtailed in the face of inflation. They're actually being seen as positive, and we're seeing margin expansion as well. So these are positive things. It tends to be for certain sectors, especially when there is inflation, they're able to take a little bit of extra price, and that helps their operating margins. So let's talk from a sector perspective, what we see going on. Just as a quick reminder, we think that when you head into a declining market, the weakest securities sell off first, one by one. And as the market sell-off continues, fewer and fewer stocks participate in a rally until you get late in the decline, very few stocks are holding on. And we saw a narrowing market over the last number of months. When we see improvement in the market, we tend to see certain groups turn up early. And then as a rally begins, it should broaden. More and more stocks should participate as the buying increases. More sectors participate, more stocks participate until you get to a point where almost everything's working again. And then by that point, people are pretty fully invested. Sentiment is really positive, and generally it's the weak sectors that roll over first. Often while the indices carry on, a lot like the Nasdaq did until December, while the weaklings under the surface were selling off, the big 5 or 6 held on. But ultimately, if enough stocks break down, you go the other way. So let's talk about breadth for the market this week. Our breadth model for Canada improved this week back to green and put the long-term indicator for Canadian stocks back to positive. NYSE reversed from red to green. The percent of stocks in uptrends went from 33% back to 40% and is now improving. So we have expanding breadth for the NYSE. And under the surface, the percent of stocks trading above their 50-day moving average for both Canada and the US improved. Percent of stocks with weekly positive price momentum in the US improved. Percent of stocks trading above their 150-day moving average improved. So we have both our short-term and long-term indicators positive once again, which means that we can start redeploying capital. We started putting positions on yesterday from some of the positions that were shaken out of the equity portfolio. We continued today. And that will continue over the next few days as we see the market continue to build on what we've seen over the last week. From a sector perspective, we can say that lots of sectors got pretty sold out. We're seeing some small improvements. So we're watching for signs that there is sort of a rebuild of strength in technology. Frankly, it's going to be a bit of a show me story, but we know that the leadership groups, are acting pretty well. So let's talk about those. Our job isn't to be everywhere. Our job is to focus on groups that have a tailwind, where there's some structural change taking place that could benefit them for an extended period of time. And we've talked about the fact that reflation supports certain industries. And we've been also noting that in those groups, the price behavior of those groups would support that view. So there's been pretty clear leadership. We watch every day for change in leadership, and that can always happen. And if there was no leadership, we'd be happy to sit in cash. So over the last few weeks, we got shaken out of a few positions in our equity portfolio. Really, that's about the only place. And we do have a little bit of cash there. But in the other portfolios, we stay pretty fully invested. It is a tactical approach. Our job is to make changes as required. So let's revisit our leadership themes. Clearly, for income investors, bonds continue not to be leadership. And we continue to have an absolute minimum exposure to fixed income. The only place we have it is in our balanced mandate, which is mandated to have a minimum 25% bonds. Frankly, Jim Skatakis has been a magician over the last year. He had a positive return in a bond bear market in the bonds portion of the portfolio. So kudos to him on that. We've not been focused on high dividend paying stocks. You can see they've been relatively underperforming, absolute negative performance since May, and relative underperformance versus the market through that period. Where we have been focused is in dividend growth securities. So our income portfolio that can be anywhere is not in fixed income in any way. It's not in preferred shares. It's not in high yield bonds. It's not in high dividend paying stocks. It's in companies that have a high likelihood of raising their dividends, which would be attractive in a world where rates are rising. So we think that's a relatively early days for this theme. We think there's lots of money that can come from other buckets and find its way into this theme. And you can see the relative performance through this recent little pullback has been quite positive. We're trading just not far off the highs. And frankly, dividend payers relative to non-dividend paying stocks are seeing one of the most significant pickups in relative performance that we've seen in the last several years. And that would make sense if we're at a generational shift. So we believe that for new money, for people who are looking for cash flow, we need to own dividend growth stocks. And I would say that our team has done a really good job of finding companies with a likelihood of raising their dividends, whether it's in financials or whether it's in consumer discretionary groups, or frankly, what we talked about last week, some of the large upstream commodity producing companies. This ETF has a 3.4% dividend yield, likely to grow double digits. That looks pretty attractive versus a 10-year bond at 1.8%. So the banks are behaving well and constructively, have significant dividends. We should expect a significant dividend growth. They fit into the story. We have lots of positions within energy that have raised their dividends recently, lots of positions within financials, lots of positions within the basic materials group, lots of positions within industrials. We have several dividend paying technology companies. The dividend cohort within the technology space way outperformed the non-dividend payers over the last 2 months. We have some consumer staples, communications, real estate, and a smaller percentage of utilities. So back to equities. The first question is our largest weight continuing to perform well? This is an equally weighted ETF made up of the Canadian banks. This is the absolute price, so we're trading just off the highs. This is the relative price performance versus the S&P, been solidly outperforming that. We started our next leg up relative to the market in October, and that is not abating. When we look at US banks, again, since September, we've seen rising relative strength versus the market. And yes, they pulled back a little bit toward the end of the correction with the market, but this is a relatively outperforming group. This is regional banks. The large cap banks have done the same thing. And frankly, for good reason, we're seeing a pickup in loans and leases. We've got the best growth in consumer loans going back over the last several years. And again, that's something that tends to happen in an expansionary, reflationary environment. We've seen nice relative outperformance from insurance companies and certainly very little dip in the pullback. So frankly, the financials theme continues to carry weight. Let's talk about energy, our second biggest weight. Energy today, this is Brent oil. We're trading basically at new highs relative to the S&P 500. Oil prices have been rising nicely, and the producers have been acting like champs. Relative performance versus the S&P made a new high today. They made an absolute new high. And let me just make a point. When the market corrects, the most important thing on the downside is to recognize where the weakness is first and make sure you use stops and reduce your position, which is why we wound up with a 6% weight in technology, while it's 30% of the S&P. On the other hand, what is it that's holding up in price? Number one. Number two, when it does sell off, and it often, if a correction is significant enough, it will hit the leadership groups. How quickly do they come back? Leadership groups should act like a cork. You pull it down below the surface of the water. When the pressure comes off, they should pop back to the surface. And look at the Canadian oil and gas sector making new absolute highs here today, while the Nasdaq is still way below the 200-day moving average. So this is exactly what we want to see, holding on late in the advance and quickly coming back to the surface. It's the same for the US energy sector. This is an ETF made up of the largest oil and gas companies in the US, up 3.5% today in a tape where the market was up marginally. So this is a chart we showed a couple of weeks ago. Energy is performing well relative to software, which is obviously a much, much bigger group. That was a great sector to be in when we were looking for reliable revenues from subscription. But it's a long duration asset is software where you're going to get paid over many years from a subscription base. Energy is a short duration asset where the price can change every day because we keep refueling our cars regularly and it just moves with the market price. Energy companies have an ability to benefit from an inflationary environment. There's the software group acting very, very differently. So my take is short duration or reflationary assets are continuing to outperform long duration assets. They tend to be, the short duration assets are a much smaller part of the market after many years of underperformance, whereas long duration assets are owned by everyone and it's a much larger part of the market. Having the right skew between those groups can make a significant difference. We've been putting this chart up that we thought we're seeing a generational shift in commodities relative to equities. This has been an underperforming period since the early 2000s. We're moving into an outperforming period, much like we did in the late 1990s, much like we did in the 1950s. So energy is acting great, but look at the degree to which the outperformance has been, it's only just beginning. And in fact, energy and oil and real assets versus the S&P 500 have had the biggest underperforming period in history other than the Depression. The oil sector was down 90%. And so this turn is early and it's something that can go on for a long time. So let's carry on into the rest of commodities. The Commodities Index made came very close to making a new high this week. The relative performance versus the market has been very, very strong. We talked last week about copper relative to the Nasdaq making a bottom. Well, the copper producers are seeing nice relative outperformance. They had much less pullback than the market going through December. They had a great rally from November of 2020 through the spring. They rested and they're beginning their next leg higher. Agricultural commodities continue to perform well. We talked last week about them holding in well. Well, here we are today making a new high in the agricultural ETF. And again, relative performance continuing to be quite strong, fueled by things like corn, soybean, and wheat, which are in shorter supply. And all of the companies in the agricultural space, like John Deere, Caterpillar, Nutrien, are faring well because they're a great demand for their products. Forest products, relative outperformance versus the S&P since October, that continues. Consumer staples continues relative outperformance. There's a couple things we've seen newer this week. We've seen some better performance from travel and leisure as reopening companies. That's something that we've added a little bit of exposure to. We did see that turn up in our sector work on some of the tech sectors. So we added small in the technology space, specifically semiconductors, which has been our favorite of the technology groups over the last year. We'll see if they can continue. We're back above the 200-day moving average in that group. We'll see whether that can continue to improve. So here we are from a sector perspective. Our job is to be in groups that are performing well relative to the market and to stay in them so long as that takes place. Our financials weight, while being down slightly from the beginning of the year, is 23% of the portfolio. It's twice the weight of the S&P 500. The energy exposure continues to move higher. It's 14% of our overall portfolio construction versus 3% for the S&P 500. That's almost a 4 times weight. It reflects the fact that it is the strongest group in the market. It reflects the fact that it held up well in the face of a decline and increased its lead over the market. And then at the company level, there are several companies behaving much better than the group, which we'll talk about in a couple of minutes. We do have some short-term government bonds, which is where we're holding some cash. And that has been, this number would be lower today than it was when we put this chart together yesterday, probably down to about 6%. Materials is sitting at 10%, over 3 times the S&P's weight. So very skewed to these camps. Technology continues to be very small. We have a small, basically a double weight in real estate, in industrial REITs. And then you can see from a long duration asset standpoint, healthcare, consumer discretionary, communication services, and staples, all relatively low weights. So I just thought this was interesting because just before we were finishing putting the deck together, I took a look at what was going on this afternoon. And I think it's really stark. The S&P at the time was up 10 basis points, or 0.1%. In our macro portfolio, we express our view using ETFs. The steel ETF today is up 4.7%. The miners ETF is up 4.4%. The oil producers ETF is up 3.9%. The transport sector is up almost 4%. The Ether ETF is up 3%. The resource dividend payers ETF up 2.2%. And you can see the rest of the numbers. This is agriculture. This is large US banks. This is travel and leisure, corn, regional banks, so on. On the other side of our macro portfolio and our structural view, this is what was happening in the positions we are short. The 30-year bond was down 0.5%. US dollars down 0.3%. The 7 to 10-year bond ETF down 2.6%. The short-term bond ETF down 2.2%. The global government bond ETF down 1.8%. You can see this is what's happening. So ultimately, when you see a turn in the market, what you want to see is the leading groups reassert their dominance. I think it's really hard to argue that that's not the case. When we look at our top 10 positions in the firm, Bank of Montreal is our very biggest position. CNQ, Canadian Natural Resources. You can see the other Canadian banks, Royal, TD, and National in this group. Nutrien from Basic Materials, and Tourmaline in energy. Our job is to use our macro work to identify the themes we want to focus in, and then use our bottom-up fundamental work where we screen 60,000 securities on about 20 factors to try to identify companies that are going through positive change, and that includes relative to the rest of their peers in the sector. And that's how we wind up with a much smaller list and a targeted list in our portfolios. So within that top 10 group, BMO at number 1, very close to making a new high, has seen relative, outperformance versus the S&P solidly over the last several months. CNQ, Canadian Natural Resources. While the XOP index of producing companies in oil and gas has made a relatively small turn, considering the fact it gave up 90% of its value from 2014, excuse me, to 2020, Canadian Natural Resources is making a new all-time high versus price. So not making a small turn to recover, a new all-time high. This is a leader within the group. When we look at Nutrien, yeah, the agriculture group turned early last year. Nutrien just chugs along and is making great progress versus the S&P 500. And Tourmaline Energy, from a gas perspective, we went from about 20 significant oil and gas producers in Canada to 3 or 4. Tourmaline would be one of them. Has a very low level of debt at this point. A great opportunity to pay a dividend as we go along. Excuse me. So just to conclude, we talked last week about the fact that after several years of energy and financials becoming a smaller and smaller part of the S&P 500, that is reversing, and we are seeing this move the other way. We think it's very early days, and that ultimately over time, they will be a much larger part of the market. Technology, on the other hand, has spent many, many years outperforming and becoming a very large part of the market. And we think it's very possible that you could see those very large cap tech companies become a less important part of the index. And this wouldn't be something that's new. In the year 2000, the top 5 stocks in the Nasdaq made up in the S&P made up 18% of the S&P. It was Microsoft, Cisco, GE, ExxonMobil, and Intel. Today, those 5 companies make up 8%. In 2016, it was 5%. If you look at the top 5 companies today, they make up 23% of the S&P. They were 25, and yet pulled back a little off the highs. But it may well be that they could underperform for some time. Now, I'm not saying that's what's going to happen, but you have to recognize that over time, money shifts from one theme to another. And if we move from a disinflationary environment that favors companies that have predictable earnings, but they come over a very long period of time, to companies that get more oomph out of their earnings in the short run because of a pickup in the economy or some inflation, that transition may just be beginning. And we think that our themes likely have a long way to go. So it was a tough start to the year for the Nasdaq. If you take the worst 10 starts for the year, it was the second worst start. It was also a tough start for the S&P, a tough start for the Dow, and a tough start for the Russell. I know a lot of people talk about the January effect. What happens in January is what will happen in the rest of the year. But if we go back to 1988 and take the worst years in January, for the Nasdaq and the S&P, of the 10, 2 wound up negative on the year. There was a whole bunch of positive ones. For the Dow, 2 wound up as being negative, a whole bunch of positives. For the Russell 2000, 2 wound up as negatives, a whole bunch of positives. And for the Nasdaq, 3 negatives and a bunch of positives. So they're all interesting statistics. We have to take the data as it comes. We have to use an empirical process to say, is the internal health of the market improving or deteriorating? As of this week, market's internal health is improving. There's very clear leadership in the market. We're very focused in those groups. We certainly are avoiding certain groups within the market we think will be challenged, and we can see empirically are being challenged. This is a day-by-day process. As we go forward, there's going to be more discussion about inflation. This is CPI over time in blue versus the bond market's take as to what will happen in inflation over the next 5 years. You can see that when CPI picks up, if the market doesn't agree that it will last, often CPI comes back down to where the market's take is. When CPI dips low for a short period of time and the market believes that actually the longer run inflation is a little higher, it tends to be CPI comes back in line with the market's view. Certainly, CPI has been elevated, and certain things within CPI or inflation are here to stay for a while, and probably that includes employment costs. But some of the bottlenecks and shortages may dissipate. All I wanted to point out is that the bond market does not believe at this point that this inflation is here to stay. So we do think that what the Fed is doing with raising rates is fundamentally positive. It's their take on the fact that the economy is improving and that the markets can handle higher rates. But I think part of the inflation may not be so sticky. Some of it may be transitory, and we'll continue to evaluate how that might impact markets going forward. In the early 1950s, there was 2 years of high inflation after the Second World War as demand picked up, but the market took care of it, and then it stayed relatively low and then slowly worked its way to higher to the 1970s. So the discussion of us getting to a 1970s style inflation, I think, is a long way away. Things get difficult, we'll get a lot more defensive. We're very happy to be defensive when the time comes. You can see we have a bit of cash in our equity portfolios as a result of this sell-off in December and January. We'll redeploy it, I think, methodically. And we look forward to a more constructive period heading towards spring. April, May should be a good run. And I think that we're just starting the next leg of reflation. With that, Pam, if there's any questions, certainly happy to answer them.
Thanks so much, David. Yes, we have a few questions this afternoon. The first one's coming from one of our newest viewers, Lawrence. He's asking to give a ballpark view, David, given the sector returns from basic materials, industrials, and energies, as you've just, and consumers, as you've just so eloquently discussed, given that those sectors are so much higher in the S&P right now, how would you weight your portfolios by sector? Just a ballpark for someone that's watching that is not yet an investor with Barometer, but should be.
Right. Okay, now remember, and for those that are on this call every week, this is a moving target, right? I mean, we are an active manager, and this is our view as it is now. It happens to be that this has been more or less our view over the last year. Financials, we think, from a risk reward standpoint, is a great sector to be in. We're going to get a combination of tailwinds. One tailwind is that as there is inflation, the assets they hold in their balance sheet, the collateral, will go up in value and their risk goes down on the loans. Second, as the differential between the short-term rates and long-term rates over time should be a little more substantial, they'll make more money on their loans. As the economy is stronger, there should be a little bit more demand growth. All those things are positive fundamentally. And because they've been held back from raising their dividends and they've got lots of cash, they're likely to increase the rate of dividend growth. And so all those things will make these attractive in a reflationary environment to investors. So we have a double weight versus the S&P in financials, but that's not just banks, it's insurance companies and some other finance companies. So we think that should be about the biggest group in the portfolio. Energy right now we have at about 15%. That's about as big as we go. Energy can be a more volatile sector, so we'll continue to assess it, but that's relative to a 3% weight in the S&P. I think materials, frankly, in our portfolio could be a larger weight. I think that we're probably bigger than this as we speak. I think we added a little bit more today and yesterday. So I think that could be a 12, 13% weight. We'll see about tech. If the semis can pick up some slack, they are a more cyclical sector. They are more tied to the economy. They are more able to raise price. They could wind up being a bigger piece of the portfolio again if they find their footing. It's only 7% now for tech in total. Maybe that's 12 or 14. There's one ETF that really I quite like in the tech space, and frankly, I'd be a buyer of it here. It's the TDIV, which is made up of tech dividend payers, and it performed much better than the tech sector in the sell-off. And so those would be important groups. I think real estate probably could be 5 to 10%, specifically in more economically sensitive groups. We like industrial REITs because they have more sensitivity to the economy. And we'll see as we start to move beyond COVID, what happens with the discretionary sector. As I said earlier, travel and leisure is starting to look a little bit more interesting. My guess is there's going to be pretty good spending there. I'd stay underweight healthcare. We'd stay underweight, probably underweight consumer staples. We'll also probably weight up our industrials piece as we go along. I mentioned that the transports, seem to be making a nice turn here. So we'll see if they can regain some strength. And if that's the case, they are a more cyclical group, probably will participate. So I wouldn't be too far off our weights, and we'll continue to iterate. You can do it yourself if you like. If you'd like somebody with hands-on, we're certainly hands-on.
Thanks so much, Dave. This question is from Paul in Toronto. He's curious, Dave, do you see the Canadian technology stocks improving in the near term? And if not, when do you see them improving?
I never postulate on a group that is underperforming when it will turn. Tech is a very broad statement. I mean, this is software. The software group off the highs, updated to last week, was off 27%. Okay, at the lows, and it's bounced a little bit. It's below all the moving averages. It's a long duration asset, meaning most of them are subscription-based companies, and so they don't fare as well in an inflationary environment. That's a generalization, but market is taking it that way. Cloud-based companies, are a long way off the highs. At the lows last week, they were 28% off the highs, and they've had a little bounce, but again, way below moving averages, and the moving averages are turning lower. Cybersecurity is similar, a little bit better, but off sort of 20-odd%, 22%, and bounced a little bit. But on a day like today, didn't have much bounce, where on the other hand, some of the more cyclical sectors acted a whole lot better. So I showed that when they start to become a smaller part of the market, it can go on for a long time. And I'm not saying that this will be the recent high for weight in the S&P, but I think it's very possible. And similarly, I think it's a much easier call to make that basic materials and energy likely wind up being a much bigger piece of the S&P. There were times when energy was 40% of the S&P 500. So at 3% or 3.5% or 4%, that could change quite dramatically. The last time we had I'll put this up because I've showed a whole pile of people this. If you go back and take a look at what happened in the last commodity bull market. So this is Rio Tinto, and this is the sideways consolidation we had from 2011 through 2021. And it broke out and it pulled back, and now it's starting in earnest, I believe, the move. The last time this happened, let's just zoom this out a little bit. The last time this happened, after going sideways for several years, Rio Tinto broke out in 2008, 2003, pulled back briefly, and then went from $20 to $138 over the next few years. That's what happens in a commodity bull market. So we're not looking for 10% returns here. These companies, Tech Resources would be another one. They could be 5-10 baggers over the next few years and pay us nice dividends along the way. So I just think there's other things to do. And listen, everybody owns technology. It's not like it's not well owned. There are not a lot of people that didn't ever think of buying it, and so they're going to buy this pullback. There are a bunch of people who bought these things at higher prices. I mean, I think Amazon's a wonderful company. But if we were to look at it today, all the people who bought Amazon since I don't know, September of 2020, 17, 18 months ago, are underwater. So there's a whole bunch of them thinking, well, if it just gets back to my price, I might be a seller. I don't want to fight through that headwind. I've already, in the groups that we're focused in, they've already done all that work and are coming out the other side of a big repositioning.
Thanks so much, Dave. The next question comes from Bill in Toronto. He just wanted to find out how the music fund, the Barometer Global Music Fund, is doing as of late. You could just comment maybe on its fundraising efforts and where we're headed.
Well, so look, just quickly, it's going very well. The fundraising has gone very, very well. There's a lot of interest. We have a lot of investors who have made initial investments. We have a number of big family offices that are involved. We have, I think, 5 or 6 potential investors right now between $20 and $30 million each. So that makes a big difference. This week, and just putting up Twitter here, this week we had a new acquisition with a couple of new catalogs, 78 songs from Bryson Tiller, which included some really top 10 R&B songs. We also had a portfolio that we bought from a writer, producer named Murda Beats, which has a ton of songs from Drake and Migos. So this was a big catalog that we bought. We're getting access to catalogs that other people cannot get to because of our music partners, who ran SOCAN here in Canada and had relationships with all these artists. So I think it's a rare thing to be able to find a long life asset that yields 8-9%. That has nothing to do with the economy and nothing to do with the market. So as a diversifier, I think it's a great asset. And I guess we're not the only ones, because we've been at this for 4 or 5 years now. But in the last month, Apollo Group and Carlyle Group and Blackstone have all decided that they want to be invested in the space too. They just don't have the same kind of music partners, I think, that we do.
Thanks so much, Dave. Well, we've covered a lot of space here, and I will leave you, as always, with the final word. And we look forward to having everybody back same time and place next week.
Look, markets don't go straight higher, and it's good for them to have corrections and shakeouts. It's good for a couple of reasons. It resets sentiment. Inevitably, bull markets shake out investors that have to wind up coming back and buying at higher prices. It gives us an opportunity to see where the real strength is in the market and where the weakness is. And I think that's exactly what this little correction did. I mean, in truth, part of the market has been correcting now for a year, and that's parts of tech. And as they always say, in a correction, generally the strongest stocks get hit at the end, and then you want to see them, how quickly they can come back. And for our leadership groups, it looks like they're coming back, like a freight train. So we have to go through these periods. The one thing I would say, if we do have some clients who I know look at their portfolios every day, I just would encourage you not to do that because you're going to drive yourself crazy. Many studies show the more you check your portfolio, probably the worse you do, and you make decisions that maybe are a little more rash. So I'm glad that you guys are tuning in. We'd love to have the opportunity to communicate with you and tell you what we're thinking. And if you have questions on any of the points we talked about today, give us a call or send us an email. We're happy to jump on at any time and have a conversation. If you're not clients of ours now, we'd love to have you. We got a really nice group of clients and some wonderful people inside the firm to take care of things. And in any business, you hope to grow, and we love to meet new people. So with that, thanks very much, everybody, for tuning in, and hopefully we answered some questions. And if not, tune in again next week. We'll try again. Thanks, Pam.
Thank you, David. Bye-bye.